This is Mercer Buller, Director of the Business Law Institute at the University of Mississippi School of Law. This video is part of our series on the basics of accounting. It covers the income statement, which may also be called the statement of operations. This video explores the elements that make up the income statement. You already know the basic structure of the income statement, which is reflected in the equation profits equal revenues minus expenses. The income statement begins with revenues at the top. Various expenses are deducted from revenues, and the net is the company's profit, or net income. What we want to cover here are the various types of revenue and expenses that determine net income. There are two categories of revenue: operating revenue and non-operating revenue. Operating revenue is revenue generated by the company's normal operations, its core business. For a widget maker, it is payments received for the purchase of widgets. For a lawyer, it is fees received for legal services. Non-operating revenue is revenue that is not received pursuant to the company's normal operations. For the widget maker or lawyer, this would include, for example, interest on the business's checking account, the sale of worn-out office furniture, renting out of extra plant or office space, or other revenue that does not reflect the sale of widgets or legal services. This distinction between operating and non-operating revenue is helpful to financial analysts because it tells them how well the company is doing in its core business, apart from revenue that is not from its normal business operations. There are four major categories of expenses, and the net income left after deducting each of these expenses tells us something important about the business. The first category is the cost of goods sold, or COGS. COGS includes direct expenses of producing the company's products or services. This would include the cost of raw materials used to make goods the company sells, the cost of buying the machinery used to make the goods, and maintaining the manufacturing plant where the goods are produced. It also includes the payroll and benefits for employees who produce the goods or services the company sells. Revenues minus the cost of goods sold generates a subcategory of profits called gross profit. Gross profit is also called gross margin or gross income. Gross profit gives analysts an idea of how efficiently a company is using the assets and personnel to produce goods and services. The next category of expenses is GS&A. GS&A refers to general, selling, and administrative services. You might think of GS&A as the expenses of operating the business other than the direct cost of producing the goods and services that the business sells. These expenses include marketing and research and development. They also include the cost of maintaining the company's headquarters and paying its executives. A company's income after accounting for the cost of goods sold and GS&A is its operating income. Operating income is also known as operating margin or operating profit. Operating income tells analysts how efficiently the company is operating before taking into account the last two categories, interest and taxes. If the gross profit is high and the operating income is low, it may be that some cost cutting in the executive suite is called for. Operating income is also known as EBIT, earnings before interest and taxes. EBIT is a commonly used measure of a company's performance. For example, a potential acquirer of a company might use its EBIT as the basis for valuing the company. EBIT therefore can play a key role in an acquisition. Pre-acquisition due diligence requires a good understanding and close scrutiny of a company's income statement. Another common performance measure is EBITDA, which is earnings before interest, taxes, depreciation, and amortization. As you know, expenses include depreciation, also referred to as amortization, of assets over their useful life. These are not cash expenses, but accounting expenses, and some consider a company's earnings, exclusive interest, taxes, depreciation, and amortization, to provide a helpful measure of a company's performance. Corporate lawyers are likely to encounter both EBIT and EBITDA frequently in their practice. The next expense is interest, that is, interest paid on money borrowed by the company. This gives analysts the ability to evaluate the effect of borrowing on a company's profitability. If a company's competitors are paying a much lower interest rate, that might reflect the fact the company is a riskier investment. or that the company simply needs a new CFO. Deducting interest expenses gives us income before taxes. As this term suggests, interest expense is deducted from revenues before calculating the tax that a company owes. What this highlights is that one advantage of borrowing is that the interest paid is tax deductible. The final expense category is taxes, which gives analysts the ability to evaluate the effect of taxes on a company's profitability. If a company's competitors are paying a much lower tax rate, this might be another reason for the company to look for a new CFO. The deduction of costs of goods sold, GS&A, interest, and taxes gives us the company's net income. This is the net income for the company as a whole. The income statement often shows net income per share, or earnings per share. Earnings per share is a commonly reported performance measure. Basic earnings per share shows earnings per share for all currently outstanding shares. This company has 100 outstanding shares and $150 in earnings, which means that its earnings per share is $1.50. The income statement also shows diluted earnings per share. This is the earnings divided by currently outstanding shares plus shares that investors and executives currently have options to purchase. This number will always be lower than basic earnings per share because the number of shares across which earnings are spread will be higher. Diluted earnings per share gives investors an idea of what earnings per share would be if outstanding options were exercised. That is, if those holding options purchased the shares they had the right to purchase. This company has issued options to purchase 50 shares, which means that earnings are spread across 150 shares rather than 100 shares, and diluted earnings per share is only $1. This concludes our introduction to the elements of the income statement. You should understand the fundamental equation underlying the income statement. Profits equal revenues minus expenses, and key categories of revenues and expenses, and what profits net of each category of expenses can tell you about a company's profitability. In our next video, we will dig a little deeper into some of the nuances of how expenses are determined.